Financial, the place where we help you forge a stronger portfolio and cut right through all the market weakness. Today, we are putting an absolute titan of industry under the microscope, UnitedHealth Group. Now, after a pretty brutal 2025 earnings report, this healthcare giant is at a critical inflection point. The stock has been hammered, and Wall Street is completely divided. We're going to drill down into these numbers, stress test the company's entire structure, and figure out if this is a generational buying opportunity or just a classic value trap.
Yeah, and let's just be blunt here. The market is really asking one simple question. Is this company built on a solid foundation, or are we finally starting to see some catastrophic cracks appear in the armor? Are they forging real strength, or are they just faking it? That's what we're here to find out.
Okay, let's just dive right in with the number that really defines UnitedHealth's sheer scale. $47.3 billion. That was their revenue growth in 2025 alone. Just to put that into perspective for you, they added the equivalent of a Fortune 100 company to their top line in just 12 months. I mean, they pulled in a total of nearly $500 billion in revenue.
And let's be crystal clear about this. This company isn't some speedboat. It's an aircraft carrier. It is an absolutely dominant force in the American economy. A true behemoth whose operations touch millions of lives and hundreds of billions of dollars. So yeah, this is the number that management wants you to focus on. That immense, powerful top-line growth. It's designed to project undeniable strength and market dominance. But you know what they say, revenue is vanity.
And profit is sanity. And while those revenues were absolutely soaring, the engine room was on fire. Earnings from operations, the core profitability of the business, it collapsed by 41% year over year.
Let me just repeat that so it sinks in. Down 41%. That is not a small dip, folks. That is a catastrophic failure. For a company of this size, of this supposed stability, a drop of this magnitude is a 5-alarm fire. It signals that something is fundamentally broken somewhere in the business model. This disconnect between massive revenue growth and a complete freefall in profitability is one of the biggest red flags we have seen in a blue-chip stock this year. This is the number that exposes all the weakness.
And that really brings us to the core conflict, doesn't it? I mean, how can a company be growing so fast and losing profitability so quickly at the exact same time? It forces us to ask the fundamental question, what is UnitedHealth Group really built on? Is this just hype, or is this real, tangible weakness?
Exactly. Is this a solid foundation of a well-run, durable business that just, hit a rough patch? Or are those massive revenues just masking some deep structural rot? Is this whole thing a house of cards? Beautiful to look at, sure, but ready to collapse at the slightest gust of wind? That's what we're here to find out.
So here's our blueprint for this analysis. No nonsense, no fluff, just a hard structural investigation. First, we'll put this titan under pressure. Then we are going to deconstruct the damage from 2025, getting our tools out to see exactly where all the cracks are. After that, we'll examine the two core engines of the company, that's UnitedHealthcare and Optum, to see which parts are firing and which ones are failing. Then we'll scrutinize management's blueprint for a rebuild in 2026. And finally, we will forge our final verdict. Let's get to work. All right, it's time to get our hands dirty. We're putting the 2025 results right here on the workbench to figure out exactly what went so wrong. This isn't just about the headline numbers, it's about understanding the specific pressures and failures that led to that 41% collapse in earnings. We have to know what broke before we can even begin to assess if they can actually fix it. And this slide, right here, it lays out the core problem in stark black and white. You can see it right there in the raw data. Revenues climbed by a very, very healthy 12%, going from $400 billion to nearly $448 billion. I mean, any other company would kill for that kind of top-line growth.
But that second line, that's where the story turns dark. Earnings from operations plummeted from a really robust $32.3 billion in 2024 down to just $19 billion in 2025. That's a $13 billion hole just blown in their profitability. And look at the net margin. The amount of actual profit they keep from every single dollar of revenue, it was a razor-thin 2.7%. The machine is taking in more fuel than ever before, but is producing dramatically less power.
Now, okay, this is where it starts to get really interesting. See, management will try to tell you the situation isn't nearly as bad as it looks. They want you to ignore the official audited number, the GAAP, or generally accepted accounting principles number of $13.23 per share. Instead, they want you to look at their own adjusted, non-GAAP number of $16.35.
And that's a difference of over $3 per share. That's not small change.
Exactly. And as a skeptic, whenever I see a gap this wide between the official reality and the company's preferred story, my alarm bells just start ringing off the hook. What exactly is being adjusted away here? What are they asking you, the investor, to just conveniently ignore? And this slide answers that question. This right here is the anatomy of their nearly $3 billion adjustment. So first, you have about $800 million in costs related to a massive cyber attack. That's a direct, really painful hit. Then you have a positive $442 million from selling off some parts of the business.
But the monster item on this list is the last one, over $2.5 billion for restructuring and other. Let's be very clear about what this means, okay? This isn't just some rounding error. This represents massive, sweeping, painful changes to the business. We're talking workforce reductions, exiting entire business lines, and writing off bad contracts. So they're asking you to treat a $2.5 billion overhaul as a one-time event. And I have to ask, when a company this big needs a multi-billion-dollar restructuring, is that really a sign of strength? Or is it desperation?
And if you want to know why they had to restructure in the first place, look no further than this chart. This, right here, is the smoking gun, the medical care ratio.
Right. So the MCR is one of the most critical health metrics for any insurer. It basically measures how much of every premium dollar is paid out for medical services. In 2024, it was 85.5%. Then, in 2025, it shot all the way up to 88.9%. That 3.4 percentage point jump is absolutely enormous in this business. It means their medical costs are spiraling upwards at a much, much faster rate than their premiums are.
This single ratio tells us that their core business of pricing risk is under severe, unsustainable pressure. This is the root cause of that profit collapse we saw earlier. Okay, so we've established the damage is severe, and it's clearly rooted in these rising costs. Now we need to go a little deeper. A company as massive as UNH isn't a single entity. It's really a conglomerate of giant businesses. To truly understand its health, we have to pop the hood and examine its two primary engines: the legacy insurance business, that's UnitedHealth, and the new age health services business, Optum. We need to see where the real strength is, and maybe more importantly, where the critical weaknesses are hidden. And here they are. So on the left, you've got UnitedHealth, the traditional insurance behemoth. Think of this as the old guard, the business of collecting premiums and paying claims. It's a massive, stable pillar serving nearly 50 million people. Then, on the right, you have Optum. This is the more dynamic, high-tech, and frankly, more complex side of the company. It's a collection of businesses that includes a huge pharmacy benefits manager, a data analytics firm, and a rapidly growing network of clinics and physician groups. These are the two distinct yet interconnected pillars holding up the entire UnitedHealth Group empire. So let's start with that insurance engine, UnitedHealth. And the pattern here is, well, it's depressingly familiar. Just look at that incredible revenue growth, up 16%, adding nearly $47 billion in a single year. It's incredible.
But that growth came at a staggering cost. The earnings from operations were slashed by 40%, dropping from $15.6 billion down to just $9.4 billion. And the operating margin was literally cut in half, collapsing from 5.2% to a meager 2.7%. Now, the company blames things like Medicare funding reductions and elevated medical costs, but the result is clear. This engine is running hotter and way less efficiently than ever before. It's just burning through cash to generate those sales.
Now, let's move over to the other engine, Optum. This is supposed to be the future of the company, right? The high-tech, high-margin growth driver. And as you can see, it's really three businesses in one. The lion's share of revenue comes from Optum Rx, the pharmacy benefit manager, at almost $155 billion. The second largest piece is Optum Health, which delivers medical care directly through its own clinics and doctors, with $102 billion in revenue. And the smallest piece is Optum Insight, the data and analytics arm, coming in at just under $20 billion. On the surface, it looks diversified and really powerful. But when you look past all that revenue and you look at actual profit, the story gets really, really ugly. This is the slide that should keep investors up at night. You look at the earnings and it's a tale of two completely different companies. Optum Rx is a profit machine, minting over $7 billion. Optum Insight is also very healthy, bringing in $2.6 billion. But then look at Optum Health, the division that actually employs doctors and serves patients. It didn't just have a bad year, it lost money. $278 million just down the drain.
Just let that sink in for a second. The segment that represents the company's grand vision for integrating care is actually acting as a massive anchor, dragging the entire Optum division down with it. A whole section of this so-called growth engine is fundamentally broken.
So the damage assessment is complete.
Both engines are showing signs of severe stress, and one segment, Optum Health, is in critical failure. So now we have to turn to the future. What is management's plan to fix this? Well, they've laid out a detailed blueprint for a rebuild in 2026.
And we need to examine this plan with extreme scrutiny. Is it a credible strategy for a turnaround, or is it just wishful thinking that's been printed on some glossy paper for investors?
Well, management is definitely framing this as a story of triumph over adversity. The CEO, Stephen Hemsley, wants you to believe that by facing these challenges head-on, they've emerged much stronger. This is the official narrative that's being sold to investors, that the pain of 2025 was some kind of necessary fire that has forged a tougher, more resilient company.
It's a compelling story, I'll give them that. But here at Iron Financial, we test stories against the cold, hard numbers. So let's see if their own forecast actually backs up that claim of strength.
And here are those numbers. And you know what? These seem to completely contradict the CEO's story. Stronger, he says. But their 2026 forecast is for lower revenue, a decline of at least $8 billion. How on earth can you be stronger if your business is actually shrinking?
Because in the same breath, they're projecting a massive increase in earnings from operations, from $19 billion up to over $24 billion. This is the textbook definition of a shrink-to-grow strategy. They are literally planning to get smaller in order to become more profitable. It's a really counterintuitive and difficult maneuver, and believe me, it is fraught with execution risk. They are basically betting the company on their ability to pull this off.
So what does this right-sizing and shrinking actually mean in the real world? It means walking away from business. It means firing your own customers. It really begs the question, is a company really stronger when its grand plan involves telling 2 to 3 million people that it will no longer be their health insurer?
Right. This isn't just some financial abstraction on a spreadsheet. It represents a massive, strategic retreat from markets they have decided they can no longer profitably serve.
And this slide shows you the exact blueprint for that retreat. This isn't speculation, folks. This is their plan. They expect to shed up to 850,000 members from their commercial plans. They are projecting a loss of up to 1.2 million seniors from their Medicare Advantage plans, and they are exiting Medicaid plans covering up to another 715,000 people. All told, they are literally planning to cut ties with somewhere between 2.2 and 2.8 million medical members. The strategy is brutal, but it's crystal clear. Identify the unprofitable customer segments and just cut them loose to protect the bottom line. This is the heavy lifting of their rebuild. Okay, so we've broken down the terrible 2025 results, we've inspected the 2 main engines, and we found significant problems. And we've reviewed the radical blueprint for a smaller but supposedly more profitable future. Now it's time to put it all together. It's time to step back, weigh all the evidence, and forge our final verdict.
Right. Is the stock now a value opportunity, forged in the fires of a difficult year? Or is this whole rebuild story just a trapdoor, ready to give way and send unsuspecting investors plunging down?
So if you're considering this company, here is your 4-point investors checklist. First, cash flow. You have to acknowledge their financial strength. I mean, despite the profit collapse, they still generated nearly $20 billion in cash from operations. This company has immense financial resources. It's not going out of business tomorrow. Second, margins. You must focus entirely on margin expansion. The entire bull case, everything, rests on one single assumption, that they can successfully execute this shrink-to-grow strategy. If they can't improve those margins, the whole story just falls apart. Third, the customer base. You have to seriously question the shrinking customer base. Management is calling it discipline.
But a bear would call it losing market share to competitors who are willing to fight for those customers. So which is it? And finally, step 4 is trust. You have to make a judgment call on management. You have to decide if you really trust their narrative, that the worst is truly over, and that this radical rebuild is actually going to work.
And that leads us to the final critical question here. The entire future of UnitedHealth Group now rests on this one single bet, that getting smaller will somehow make them stronger. They're actively choosing to shed customers and revenue, all in the pursuit of higher profitability. So you have to ask yourself, is this a masterstroke of corporate discipline, a brilliant and necessary pivot to shore up a damaged foundation? Or is this simply a managed decline, the first stage of a long, slow retreat for a wounded giant that has completely lost its way? Answering that one question will determine whether this is one of the great investment opportunities or one of the biggest traps in the market today. And that's our structural analysis of UnitedHealth Group. The pressure is immense, the damage is very real, and the plan for recovery is both radical and extremely risky. As always, this is not financial advice.
It is a framework to help you do your own due diligence. Here at Iron Financial, we just give you the tools to cut through all the noise and see the real structure underneath. For more deep dives just like this one, visit our website. Now go out there and keep forging a stronger portfolio.